Hello value investors, welcome. In today's video we're going to talk about Splunk. Particularly we are talking about its fiscal 21 first quarter results. It was a promising set of results, and also even though they pulled their full year guidance, they continue to reiterate that by fiscal 23 they should be growing with a compounded annual growth rate of 40%. Consequently, I'm less bearish this company than I was previously. I can see that it has a strong potential ahead. However, I am concerned about its actual organic abilities to generate cash flow from operations, as you'll see in the video, and I'm also concerned whether paying 30 billion market cap leaves investors with any upside potential. So if you're new to the channel, please subscribe now so you can get my next video installment. Remember, this is our value investing journey. Let's get started.
Splunk had some very interesting Q1 results. So if you're familiar, Splunk is a software as a service business and is trying to get more of its customers away from a licensing service where basically they pay up front for the license and towards a software as a service business that you pay annually. So this means that you get less revenue up front but more visibility into the years ahead. More visibility means investors will be willing to pay a higher premium for its business. This visibility should translate into it growing its annual recurring revenue at 40%. So although Splunk is pulling its guidance for fiscal 21, fiscal 21 is kind of what we're in now. We're in fiscal 21 for Splunk, which is kind of ends in calendar January 21. It's a bit confusing, the fiscal and the calendar, but anyway, so you can see that they continue to say that although we're pulling our guidance for fiscal 21, that we're supposed to grow our annual revenue growth rate at 40%. You can see that here. And what is interesting is that the more of its cloud operations it gets, indeed, the lower its gross margins. You can see that in this quarter, there was a very strong push into cloud revenue. So as a percentage of its total revenue, cloud went from approximately 35% last year, not shown in this graph, just what they said on the earnings call, went from 35% to approximately 44%. And they are on the target of reaching fiscal 23, having 60% of their revenue from cloud. But you can see here that the more that the cloud continues to grow, so it does continue to have a more expanded margin here. If you compare Q1 21 with Q1 20, it has significantly grown the cloud margin, but at the same time, it has dropped the total company's gross margin. So it's difficult to say what in 21 or 22, 23, what its total gross margin could fall at. So it's kind of complicated, but it seems to be that it might have total gross margins as approximately 70%, again, because the cloud gross margin is lower than the company's total gross margin. So Splunk is kind of putting this carrot out here for investors that by the end of fiscal 23, which is January 23, so it should have operating cash flow of 1 billion. The way Splunk argues it is that by 2023, you'll have somewhere between 4 and 5 billion in revenues. And historically, Splunk has been making 20% cash flow from operations yield. So if you kind of take the top end of that, which is 5 billion of revenues, and you 20% as cash flow from operations, you see that it gets 1 billion of cash flow from operations. Now, let's dissect this cash flow from operations. So that 1 billion of cash flow from operations, my first thought was come to the proxy to see whether management actually has any skin in the game. So I came onto the proxy statement and I just looked here at security ownership and I just looked down and you can see that the management as a whole have less than 1% skin in the game here. So for me, I was like, okay, this might be promising, but if management really believed that would be as attractive as they are claiming it would be, I would have liked them to have more skin in the game. This is not a thesis breaker, but I did kind of was considering whether investing in this company or not, and I thought, okay, let's just check this out. Decided to dig in to see its cash flows from operations, how strong it was. So I was just wanting to see how clean the cash flow from operations have been historically. So I've come into the 10K on the SEC government website, and you can see here, so that for fiscal year 2020, which just finished, so they're 1 quarter in to the new fiscal year, which is 2021, and you can see, so cash provided by operations is a negative number. That's not a problem. It's quite normal that SaaS companies invest very aggressively into revenue growth. But you can see here that they are making substantial acquisitions. Not only the acquisition substantials, but they increasing in magnitude. And as of last year, they spent close to 600 million on an acquisition here. So they're very much growing inorganically, and I'm not a fan of inorganic growth because it doesn't tell me much about the product. The product, if the goal is to get a strong, attractive business, I want the business to be attractive and to grow organically, and I don't want them to just be able to have the funds necessary to acquire businesses, because it's very difficult to acquire a business and claim synergies, and that's specifically in the SaaS world. It's very aggressive, very competitive, and you're paying high premiums, and you might not be able to get the return on investment. So I'm a bit wary of that. And then I kind of scroll down here, and I saw that a large portion of their outgoing cash is towards settlement of their options of the management. So it kind of feels to me as an investor that this company is just working for management, and I'm not really getting, if I was a shareholder, I'm not really going to get any free cash flow to myself. There are plenty of SaaS businesses that are growing fast and reasonably priced, and they're not really working just to basically pay the options of the management. So with those in mind, I've kind of felt that it was just not worthwhile investing for me.
So on the one hand, there's the promise of 40% annual growth rate, and on that assertion, investors are willing to disregard pretty much anything that falls below the revenue growth line. But it's a difficult game because you have very little idea of what its operating margins could be at some point in the future. As we discussed, although it gets 5 billion in revenue, an estimate 5 billion in revenue by fiscal 23, and approximately 20% of that should flow for cash flow from operations, the large bulk of its stock gets added back. So yes, the cash flow from operations could be 1 billion, but it's difficult to know how much of that is stock-based compensation, because that is a cost that gets added back, but it means that the shareholder gets more and more diluted over time. So it's too many questions. It's a bit uncertain. Yes, it is more positive than it was before, but on that premise, I'm not going to be investing here. So anyway, hope you found this video useful. I'll see you next time.